Hello and good morning everyone. Today, we will learn on a new chapter that is corporate governance and fraudulent financial reporting. What are the basic principles of corporate governance? The basic principles of CGR. Ensuring the basis of an effective corporate governance framework whereby must provide transparent and efficient marketing consistent with the law. Responsibilities of the board. Must ensure strategic guidance of the company, effective monetary management and board's accountability to the company and stakeholders. Roles of stakeholders. Understand their right and promote cooperation between company and stakeholders. Fourth, equitable the treatment of shareholders. The company must treat local and foreign shareholders equally. Fifth, disclosure and transparency. Ensure timely and accurately disclosure is made on all materials in the company. The importance of corporate governance are: to prevent any corporate scandals, fraud and criminals liability. To enhance company's image in the public eye since it provides assurance in terms of internal control. To keep the company on being honest and free from trouble. To protect the stakeholders' interest. Directors' responsibilities to ensure good corporate governance are: to observe and enforce the high ethics since they are the head of the company. To disclose any conflict of interest and responsible on any information in the company. They must be evaluated and transparent, fair and consistent in terms of remuneration policy.
Next we move on to Audit Committee, its structure and roles. First, do you know what Audit Committee is? Audit Committee is an operating committee that is in charge of overseeing the financial reporting and disclosure of the company. They are normally required in all listed company, federal statutory bodies, banks and financial institutions. Why is it important for a company to have an Audit Committee? Audit Committee is important as it strengthens the accountability and corporate governance of a company in order to provide greater protection for shareholders and the investing and depositing public. Here is an example of Audit Committee structure. Next, let us move on to the roles of Audit Committee. The Audit Committee plays an important role in: first, assisting the Board of Directors in discharging their statutory duties and responsibilities. Second, monitoring the company's activities in terms of their ability to access the accounting records of the company. Third, increasing the public confidence in terms of the company's credibility and objectivity of the financial reporting of the company. Moreover, to ensure that the report are free from biased judgment. Next one is assuring the internal control of the company is strongly established and effective. Last but not least, ensuring an adequate attentions are given to the risk management of the organization.
What are the drawbacks of having an audit committee in an organization? Undermine the interference in executive decision on operational matters. Audit committee will tend to undermine the authority of the board, where this will lead to the conflict of mistrust and misunderstanding among the committee, management, internal auditors and external auditors. However, it can be prevented by having clear terms of responsibilities of audit committees, and communication between all parties should be made on timely basis on professional manner. Secondly, audit committees have no teeth. The committees are just window dressing to comply Bursa Malaysia listing requirement. It can be prevented by giving authority to back up their responsibilities where they need to be seen as independent, while Board of Directors need to support the committee in financial and administrative resources in order for them to carry out their duties. Thirdly, the Board of Directors, BOD, is distanced from financial matters and the external auditors. This has happened when the BOD discharged his duty to the committee but still has full responsibilities on the financial matters of the company. It can be prevented when the BOD require oral and written report on all the activities of the committees, or may even call the auditors to attend the meetings. Last but not least, legal liability of audit committee members. The committee does not relieve the BOD of its responsibilities for the financial reporting process. However, committee members may increase their exposure to possible additional liability because the extra responsibilities entrusted to them.
Next we are going to learn about fraud and error. Misstatements in the financial statements can arise from either fraud or error. Errors are unintentional misstatements and may involve mistakes in gathering or processing data, unreasonable accounting estimates arising from oversight of facts and misinterpretation of facts, and differences in the application of accounting standards. Fraud are intentional misstatements and may be classified as fraudulent financial reporting, which the acts of manipulation, falsification, or alteration of accounting records or supporting documents, misrepresentation or intentional omission of transaction in the accounts, and misapplication of accounting standards. The second classification is misappropriation of assets, which the acts of embezzling cash receipts, stealing assets and payment for goods or services not received. For the purposes of the AUD6, the auditor is concerned with fraud that causes a material misstatement in the financial statements. Two types of intentional misstatements relevant to the auditor are misstatements resulting from fraudulent financial reporting, and misstatements resulting from misappropriation of assets. An example of fraudulent financial reporting is a company that ships customers goods that have not been ordered and then records the revenue as if it met all the criteria for revenue recognition. While examples of misappropriation of assets is thefts of cash, inventory or securities. ISA 240 defines fraud as an intentional act by one or more individuals among management, those charged with governance, employees, or third parties, involving the use of deception to obtain an unjust or illegal advantage. There are three types of fraud, which are transaction fraud, financial fraud, and occupational fraud. Example of transaction fraud are the theft or conversion of company assets to individual use, and mythical employees or suppliers may be added to company records to whom monies are paid for services or goods never delivered. While financial misstatement fraud is the intentional misstatement of certain financial values to enhance, or reduce, the appearance of profitability and deceive. Management may be motivated by reason of promotion, bonus or some other preferment. Occupational fraud is defined as the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employing organization's resources or assets.
Now, let's move on to the responsibility of detecting the fraud. It can be divided into two groups of people, which are management and auditors, where both of them are responsible to detect, prevent and correct the fraud on timely basis. Responsibility of management. The primary responsibility of management is to take reasonable steps to prevent and detect fraud and error within the company. It can be done through implementation and continued business operation with an adequate accounting and internal control systems. For example, installing an effective accounting system, installing an effective internal control system, establishing an internal audit function, and appointing the audit committee. Responsibility of auditor. Due to inherent limitation in conducting the audit, the risks that have some material misstatement will not be detected. Fraud may involve sophisticated and carefully organized schemes. Thus, an audit does not guarantee that all material misstatement will be detected, and it will be not fair by blaming the auditors for not detecting the fraud. When obtaining the reasonable assurance, an auditor should maintain an attitude of professional skepticism throughout the audit. Assess or identify the factors related to fraud occurrence, and perform procedures to detect fraud. Specific fraud risk factors cases. Fraud diamond. What is fraud diamond? It is an individual's capability to play a major role in whether the fraud may occur, even if there are the presence of incentive, opportunity and rationalization. There are two fraud risk factors. Fraud triangle. First, fraudulent financial reporting, FFR. Management. Second, misappropriation of assets, MOA. Management and staff. The discussion among the audit team are: audit planning memorandum, sharing of knowledge about the client, emphasize professional skepticism, having knowledge of external and internal influences that might create pressure, incentive,